Welcome back to another explainer. Today, we're doing something a little different. We're setting aside the thrill of winning trades to conduct a very calm, very objective financial autopsy. We're looking at the GoldMining Elite Multi-Major Signal Series, specifically episode 08, which covers the events of week 26. We are pulling up the exact MT5 reports and the hard data for account 373-11764 to see exactly what happens when an extreme market event hits. Negative 99.94%. That is the number that completely defines week 26, a near total wipeout in just 1 week. You know, in the world of algorithmic trading, it is absolutely crucial to face numbers like this head-on. No sugarcoating, no making excuses, just a cold, disciplined look at the raw data. So let's dive right in. The journey for this specific account? Well, it's over. The total lifetime growth closed out at negative 99.89%. This was a live public signal trading 4 major currency pairs. And what we're going to do in this explainer is unpack the anatomy of this exact collapse. We really want to understand how a strategy that had accumulated such steady gains over the previous weeks could just shatter, experiencing an exceptional adverse market move in a matter of days. But before we can truly understand the fall, we have to look at the climb. Section 1, 17 weeks of growth, and establishing our baseline performance. It's really important to establish right out of the gate that this was a live cent account. It was originally seeded with 25,079.97 cents, which translates to roughly $250. So we're not talking about some massive institutional fund here. This was a deliberate, highly calculated test of an automated, multi-major strategy running in real market conditions. The contrast here is just staggering. If you look at the equity growth curve across this first 17 weeks, you see this beautiful, steady, methodical accumulation. The algorithm was doing exactly what it was programmed to do, capitalizing on normal market fluctuations. But then, we hit week 26, and the bottom literally falls out. It is a sheer cliff. The floating drawdown in red spikes aggressively, and that blue equity line just plummets straight to zero. And hey, before we jump to the conclusion that every single currency pair was failing, let's look at the historical data. Over the full history of the account, the US dollar against the Swiss franc, USDCHF, had actually been the strongest, most resilient performer. Look at that green profit factor bar extending way past the others, sitting at 2.08. The strategy was absolutely working until the environment fundamentally shifted. Which brings us to the core of our explainer today, Section 2, Anatomy of a collapse, focusing on the extreme market move that ultimately broke the algorithm. The crucial point of failure is mapped out clearly on this 1-week MT5 chart. Watch the divergence between the light blue balance line and the purple equity line. For the first few days of the week, they are locked together, moving in tandem. Then, suddenly, that equity line begins to rapidly detach. Floating losses were just piling up way faster than the algorithm could close them out, and that triggered a catastrophic margin cascade. It highlights a really harsh fundamental reality in quantitative trading. Automated strategies can perform consistently for extended periods before rare market conditions expose their weaknesses. An algorithm is ultimately only as robust as the historical data it was optimized on. When a true black swan or a rare macro event hits, the technical indicators that the bot relies on can become entirely decoupled from reality. So, to find out exactly what broke this system, we need to look under the hood. Section 3, the currency breakdown. We're analyzing the exact MT5 trade logs here to isolate the damage. Looking at the net profit by symbols, you'll see a massive hollow red bar for USDCAD, and the money chart confirms this perfectly. While the lines for USDCHF, USDJPY, and EURUSD do dip slightly, it is that purple line, representing the US dollar against the Canadian dollar, that violently crashes down to negative 32,609 cents. USDCAD generated the overwhelming majority of these devastating losses. This brilliantly illustrates the exact point of failure. Pairing the massive USDCAD MT5 sell logs alongside the price action makes it so clear. The algorithm was aggressively scaling into sell positions, fully expecting a reversion to the mean. But looking at the chart, the market was in a relentless, punishing uptrend. The strategy just kept fighting the trend, and the trend won. Now, while USDCAD delivered the fatal blow, EURUSD and USDJPY definitely compounded the issue. They contributed relatively minor losses compared to the Canadian dollar, sure, but in a margin-constrained environment where the account is already bleeding heavily, Every single negative pip accelerates at final margin call. And that brings us to the cold finality of the numbers. Out of an initial starting balance of over 25,000 cents, when the dust finally settled and the last trades were forced closed by the broker, exactly 28.12 cents remained. So what actually caused the charts to move so violently against the technical indicators? Why did USCAD trend so relentlessly? That takes us to Section 4, the perfect macro storm. Algorithms rely on technicals, but markets? Markets are driven by fundamentals, and week 26 was a geopolitical powder keg. First off, we had persistent overarching US dollar strength, heavily driven by shifting Federal Reserve expectations regarding interest rates. But the real catalyst was the severe geopolitical uncertainty stemming from US strikes on Iranian nuclear facilities. This objectively created massive volatility in the energy sector. Because the Canadian economy is so heavily reliant on oil exports, that high oil price volatility directly impacted the Canadian dollar. It created a wildly unpredictable environment across all major pairs, but it acted as a hypercatalyst for the USDCAD pair, which ultimately destroyed our account. This is exactly why we document everything so meticulously. Section 5, Real Accounts, Real Risk, and the core philosophy of this project. We do not hide our failures. You'll see a large QR code on screen right now, and I highly encourage you to scan it with your phone. It will take you directly to the archived live signal data. You can verify every single trade, every loss, and every metric we've discussed today for yourself, and you can monitor our future signal projects there as well. We firmly believe that disciplined transparency is far, far more valuable than making excuses. Which leaves us with our guiding ethos: real accounts, real risk, real results. When you expose real capital to the live markets, you are exposing it to real-world risks, including black swan geopolitical events that literally no code can predict. So I'll leave you with this final thought. If automated perfection is just a myth, is the true secret to algorithmic success found not in avoiding drawdowns altogether, but in how meticulously you study your own financial autopsies? Keep learning, stay objective, and we'll catch you in the next explainer.